Hello, and welcome to the Alta Group and Cloud Lending Solutions joint webinar, Fintech Disruption in Leasing. I'm Scott Smith, VP of Product Marketing here at Cloud Lending Solutions, and I'll be your host today. Before we get started, I wanted to introduce our two companies and speakers. Since 1992, Alta Group has been a trusted advisor to the equipment leasing and finance industry focused on market opportunities, sustainable revenue growth, and operational efficiencies for clients. Services provided include digital business advisory, mergers and acquisitions, management consulting, asset management, and legal services. Cloud Lending Solutions is a financial services technology company offering a cloud-based end-to-end leasing platform delivering origination, underwriting, servicing, and collections. We have some fantastic speakers planned today, so let me go ahead and introduce you. From the Alta Group is John Rizzi, Managing Director, Digital Business Advisory Practice, and Patricia Voorhees, Director of the Strategic Consulting and M&A Practice. From Cloud Lending Solutions, we have Mukul, EVP of Product Development. We have an informative and thought-provoking agenda planned, so during the presentation, we would like to hear from you. For questions and comments, please submit them to your GoToWebinar console's question box, and we'll answer them at the end during our Q&A. So enough of the preliminaries. Let's get started. We turn it over to Patricia. Patricia?
Thank you, Scott, and thank you everyone for joining. So really when we look at the topic of this morning's discussion, which is what does FinTech mean and what level of disruption is or isn't happening, specifically in the equipment leasing space, I'll start with a couple of things. One is that it is actually early days in terms of adoption of new models and the amount of financing being done through those models, and how more traditional companies are looking at extending technology they already have and other ways in which they can embrace and think about an appropriate strategy for them from a FinTech standpoint. If you look at the trends that are up on this slide, there's a number. I'll put them in three categories, and three categories of things that really positioned us or has opened up the market for FinTech in the equipment leasing space and small business lending generally. And the first piece of it is the technology. There are technologies out there today through cloud types of technologies and certainly mobile technologies that have made the deployment of financing solutions much easier and much more user-friendly. And that gets us to the second piece of it. Beyond the technology, there's been some demographic shifts. If you look at the millennial generation, and they're often called digital natives. And so the user expectations and the way that they want to use technology and the way that they want to buy equipment and finance equipment is much different than it has been traditionally. And I think there's implications that we need to think through from a leasing, origination, and support standpoint. And then lastly, but also very important, is the changes post-Great Recession in the banking industry. There have been significant changes, and if we move to the next page, you can see that there really has been significant changes post-Great Recession. And these are related to more conservative credit policies that are to some degree related to the introduction of regulation through Dodd-Frank, through increased capital requirements. And those things have actually brought additional costs for banks. So to originate smaller transactions can be more costly for banks. All that together has really reduced the amount of loans, and you can see on the left-hand side of the chart that there's been a full 16% reduction in the number of loans that have been underwritten, but they're fully, more than 40% reduction in the amount of dollars that have been lent. And if you look over on the right-hand side of this chart, this is critical as well, because it says that if you look at the number of small, medium businesses out there that qualify for bank underwriting criteria, better than 75% of those do not. And so those two, the pullback from the banks and the fact that so many of these small businesses that need to grow and are providing growth in our economy don't have access to traditional banking. If we move to the next page, now you can see the what is really happening in the equipment leasing industry. It's an enormous market. $1.6 trillion, and this is in the U.S., of equipment is purchased each year. And of that, fully $1 trillion of it is financed in some way. And more than a third plus of that is done through lease and loan transactions, and the balance of that trillion is done through some other financing vehicle, whether it's a corporate credit card or a working capital line or some other mechanism for financing that. So $1 trillion financing market is just an absolutely enormous market. And then if you look over on the right-hand side of the chart, you can see that there's been a real change. And the significant change when you take a look at this is that more and more of financing is happening either through vendor types of relationships or through captives. And there's been a 10-14% increase in terms of the financing that has gone from a direct model, meaning potentially a small business going to their bank or other non-bank lending source that are going directly to end customers and asking, if there are items that they want to finance and going directly outside of the actual transaction. But what this trend is saying is that more of the decisions about financing are happening in vendor or captive relationships and at the point of sale. And I think that's a really significant change and another true opening for the fintech space. And so if we move forward then and take a look at what are the real key changes or the key things that are critical in terms of success in the fintech space, overall, it's mastering both sides of fintech. So there are today, I mentioned at the onset that we are in the early stages, and there are a few pure plays, fintech pure plays in the leasing market. An example I'll give is Currency, who actually integrates leasing at point of sale and have really taken advantage of that trend of financing happening closer to point of sale and integrated that financing, bringing the process online and also automating a marketplace such that there is many lenders on the platform and they're matching the right credit and the right asset and the right duration with the right lender. And so that is an example, and both John and Mukul will go through other examples, both in terms of traditional lessors who are deploying technology and some other fintech models that we can discuss. But right now we're early days, so there's few pure plays in the space. It is important to really master both sides of fintech. So the technology needs to satisfy what the user requirements are, increasingly be available so that the financing decision can be made as close to or at the point of sale along with the equipment. At the same time, the traditional things that have made finance companies successful continue to. So whether or not you're deploying AI or other technologies on the credit side, you still have to get credit right. You still have to manage the portfolio. You still need to understand performance over different vintages of your portfolio. So none of the things that make a finance company successful are gone here. It's just the addition of technology and what it introduces in terms of speed of origination and reducing the cost of origination and therefore the cost of customer acquisition, which is proven to be and continues to be a real differentiator for pure fintech and other companies that are deploying technology to bring down the cost of customer acquisition. I'll just emphasize again the importance of the trend to more and more of the decisions happening at point of sale. If you look at Forrester Research, had last year about $700 billion of B2B equipment and supply sales that were done online, and that's expected to hit $900 billion this year, and then quickly after that exceed $1 trillion. So more businesses, more B2B transactions are simply happening online. And so understanding the impact of that from a financing standpoint and what that means for your organization is a critical piece of this. And then, the next piece of it is what's the balance sheet strategy. Honestly, whether you are a traditional finance company who weathered the Great Recession, or you're a new fintech player, diversity of balance sheet and funding sources, whether that's multiple bank lines, whether it's bank lines matched with some level of securitization, or utilizing some sort of crowdfunding or certified investors, but multiple sources, and this was really evidenced by the disruption earlier this year at Lending Club, but understanding your funding strategy and having diversity and depth in your balance sheet is certainly key to any finance company, and certainly is key for fintech players. So overall, as I said, I think we're at the beginning phases. If you look not only across leases, but if it's small business loans, about $20 billion or so is expected to be done this year through alternative lenders. But we saw how large just the equipment leasing market is. So we really are at the beginning phases, and at an exciting time in terms of understanding what is happening in the leasing market. If we move forward to the next page, you can see there's a number of things that this is a survey that PwC did earlier this year. And so there's a number of things that companies are concerned about when they think about fintech. They're concerned about whether it's going to impact their margins. They're concerned about whether it's just going to be an overall competitive issue for them. Will they lose customers? Does it mean they'll have more churn in terms of customers? Will introducing technology out to customers create more of an opportunity or issue with security and data issues? So these are the things that they're thinking about. And if we move forward then to the next page, it says, so what are companies thinking about? So they're thinking about, should they be partnering with fintech companies? An example here is what happened with the partnership between JP Morgan and On Deck Capital. And, should they be thinking about investing or partnering? There's plenty of examples in the banking space between Citibank and Bank of America and TD and plenty of others who have started venture funds and have some sort of incubator to think about how they should introduce fintech to their customers and really satisfying what the changing user requirements are. So overall, it's early days and an exciting time and an important time to be thinking about what fintech means, what opportunities and challenges it introduces to your organization. And now I'll hand it over to John Rizzi, who will talk about how some customers, both newer and more traditional, are deploying digital technologies to satisfy user requirements. John?
Thank you, Patricia. Greetings, everyone, and again, thank you for joining us today. So let's talk about fintech and leasing. The fact is the leasing industry has used innovative technology to drive growth for many years. Auto decisioning systems have been around for 30 plus years. Mobile apps, e-docs, e-signatures, portfolio analytical software. So what is it about the current fintech movement that is going to drive the change in our industry? Well, probably if you go back to our market drivers slide here, the most important factor driving the evolution is really going to be the customer and the customer's user experience expectations. The fact is that millennials have little to no affinity for traditional banking systems and brands, and they're quickly becoming the core buying influencers and will become the sole buying influencers in the not too distant future. Catering to their user expectation needs is what's going to drive the origination strategies of the lessors of the future. In conflict to the customer expectations is our legacy system complexity. While the lessors have applied and pioneered numerous financial technologies, they have done so in mostly older technology platforms that have led to legacy technology complexity. Many organizations develop their systems in closed environments, requiring custom systems and design to drive customer-facing innovation and operational effectiveness. While lessors have been successful fulfilling the needs of their customers with this approach, the user of the future will most likely gravitate to platforms that allow them to source multiple funding offers with just one application submission. With that, over the next few minutes, we're going to talk about some of the more prolific technologies that have and will continue to change the core operating platform designs of the lessors of the future. Our first example is Agile Approach. Innovative leasing software is being designed with open architecture that is more flexible, allowing lessors to configure their unique go-to-market and operational attributes, as opposed to requiring custom coding. This agile approach gives lessors the ability to use specialty third-party apps, employ their own business rules and workflows, and more easily develop unique user interface portals. Open architecture will allow more lessors to have greater access to specially designed applications, and will be how these applications are applied to the user experience that will drive the differentiation and competitive advantage for the lessors of the future. For customer intelligence, electronic activity registers are and will continue to be exploited by data gathering and analytical software. As the internet continues to become the data warehouse of record for every decision and transaction we make, software will become better at profiling companies for the benefit of lenders, providing predictive intelligence about equipment needs and borrowing propensity. The growth and sophistication of smart devices, coupled with this user profiling technology, is poised to change the buying cycle dynamics of the future. Moving on, another innovative disruptor is what we call peer-to-peer leasing. Another innovation in this model, bespoke leasing programs target groups of users of common assets. Uber started what is essentially a captive for auto leasing. Only available to Uber drivers, they finance new and used cars to those within the group that do not already have an automobile that would qualify as an UberX vehicle. In 2015, Uber and the Exchange Leasing Program secured a $1 billion facility led by Goldman Sachs, and they recently projected that by the end of 2016, it will have provided 100,000 vehicles financed under the program. The program itself is designed to address the unique needs of an Uber driver, with offers including no or low down payments, unlimited mileage, free oil change, tire rotations, and in-cabin air filter replacements, no-cost trades, and easy lease termination provisions. The convenience of payments and automatically deducted from Uber paychecks are also an important feature for this group. On the equipment leasing side of the equation, we have LeaseQ. LeaseQ is an example of a company that has emulated the fintech business model that Patricia spoke about in the SMB bank loan space and applied it to leasing. They have established lender relationships interested in providing lease financing to users of 22 different asset classes of equipment, including medical, construction, technology, fitness, etc. The lenders provide asset class and equipment-specific pricing models, and LeaseQ aligns those applicants to the customized asset class programs, thereby creating a peer-to-peer borrower to lender model. No discussion about fintech would be complete without discussing the cloud. While cloud-based alternatives have been available for quite some time, adoption and utilization has accelerated significantly in the past couple of years as increased in the confidence of the technology grows. The equipment survey from 2014 revealed that 82% of respondents said that their organizations used either a public or private cloud in some way. 2 points that I'd like to make regarding cloud technology that is relevant to our discussion today. One, cloud-based systems is one of the key drivers supporting the multi-funder models of fintech originators, creating a common pipeline where data can be shared amongst multiple parties, i.e. lessors, simultaneously. Secondly, when you couple cloud services with cloud-based software, it significantly reduces the cost of entry barrier, which has been historically very high for new companies seeking entrance into the equipment leasing space. Now let's talk credit. Access to external data sources beyond D&B, personal credit information, and in-house experience have blossomed. Credit decisioning systems today are automatically retrieving upwards of 700 data elements from numerous sources, inclusive of banking and electronic payment records, financial statements, both public and private, delinquency data, personal history, business records, and filings. Software is mapping line data, producing cash flow and other financial spread analysis within seconds, and customized algorithms are providing scores and recommendations to underwriters and credit decision makers. While users still need to provide authorization to access many of these electronic records, the greater level of detail and sophistication will allow users to shop for multiple lenders almost simultaneously. Lastly, what are we thinking about our legacy systems and change as an industry? You know, the good news is that the leasing industry has historically embraced new technologies and have proven to be very innovative. Legacy systems have worked wonderfully for the industry, and innovative lessors have customized and added on new technologies to support growth and capture ever-growing market share. What will drive the technology evolution that will allow lessors to participate in the platforms of the future, taking full advantage of the new technologies, and most importantly, capitalizing on the customer future expectations and demands. This slide shows that many recognize the need for change and that our legacy systems are admittedly not sufficient to meet both current and future needs. It's probably safe to say that adoption of the new technologies and platforms will occur over a number of years. But what the core drivers will be for each company to seriously consider a change of this magnitude is certainly still a big question. But I think that you'll all agree that as to where the industry is headed, and that change is absolutely inevitable. That's all I have for you today. Our next speaker is Mukul, who will provide some ideas about how you might approach a fintech strategy in your company. Mukul?
Thank you, John. So I wanted to start with, how do you go about your fintech journey? And, talk a little bit about the different technology options that are available, what you may want to leverage. So let's look at marketplace. The marketplace or peer-to-peer phenomena has a low penetration in leasing. And one of the things could be that which is preventing adoption is the asset ownership, or is it a disruption waiting to happen? On the other hand, let's talk about social media. Social media has been very effectively used in the consumer space, but in the B2B space, which is primarily where leasing is, how can we use social media? Is it to understand reviews of business, the customer service aspect of organizations? Yeah, is there a play for digital wallets? Can we put approved credit lines onto digital wallets for our customers to use, or use near field communications for RFID tracking, for asset tracking, crowdfunding, or will something like blockchain and Bitcoin really change the way that we transact in currency? But this is all fun stuff. Before we get too carried away out there, we've got to come back and see what is the problem that we want to solve. Is it a problem of the business flow? Is your workflow the issue? Is multiple systems your issues? Is connecting with different partners or third parties your issue? Or is it around a business process like origination or asset management, or giving your customers a 360-degree view? So till you don't identify your problem, you could end up just trying to leverage technology for the sake of technology, and that may not get you too far. I wanted to spend a few minutes talking about my friend Peter. Peter's built a business around leasing Harley Davidson motorcycles and Indian and Victory motorcycles. This is more of a lifestyle. A person who wants a Harley wants a Harley. You can't give them some other bike. So he used technology to smoothen the entire process, that when anyone comes into a dealership, that they can walk out with their bike. They're very passionate about it. And Peter keeps telling me he's running more of a technology company than a leasing company. The other part which you really need to evaluate, do you want to reinvent the wheel? Is there Are there advisors? Are there people you can leverage on who've gone through the journey, who understand your business that you want to leverage? Or do you want to just take a technology and start from scratch building it out? My suggestion would be that you identify what area you want to tackle, whether it's strategy or operations or your technology challenges, and find the right advisors. There are good advisors available who worked in technology, who worked with customers, who can help you. It's not that you won't make mistakes, but the number of mistakes could be minimized. And then I wanted to leave you with a thought that, is this the end of the fintech journey? I don't believe so. I see fintech 2.0 coming, and fintech 2.0 will be built, I assume, will be built around the Internet of Things. Now, when you talk about the Internet of Things, this could potentially impact areas of leasing like asset tracking, maintenance, delinquency, because when something stops working, the customer stops paying. How you could upgrade or modify, replace equipment, potentially even pricing based on more modified usage terms. With this, I'll stop here and give it back to Scott.
Great. Thank you, Mukul. Thank you, Patricia and John. Great informative presentations. We're getting a number of questions in, so please submit your questions into the question box, and we'll try to get to them as quickly as we can. The first question we have here is for Patricia. Are there companies now partnering with fintech providers, I assume? And if so, how are they doing that?
So yes, so I'll give you a couple examples. One I touched on briefly. So JP Morgan announced in a relationship with On Deck Capital where they're extending and offering the ability toward loans for small business through that technology. And there are certainly others. I mentioned actually Currency previously. They've partnered with one example of their partners is eBay. So they've partnered actually with an equipment supplier and are integrating the financing at point of sale. And there are many other examples out there on the consumer side as well. And as I mentioned, there's some of the larger institutions, Citibank and Bank of America and Wells Fargo and others, have venture funds and are looking at deploying strategically capital and helping these companies grow, where they see that they can add a product through offering or offer it on a offer the technology on a private label basis. And I think we'll see more of that.
Okay, great. There's another follow-up for you. This was during the early part of your presentation, Patricia. So I think it's in context of what you were talking about. In terms of what do you see as the difference between vendor and captive relationships? Think in terms of the trends and so forth.
Sure, for sure. So I mean, just from a definitional standpoint, so a captive relationship is an organization that has their own captive finance company like Cisco and IBM and Cat and Deere and others that are about financing their own products, where vendor relationships can be with dealers or distributors or manufacturers, and it could be third parties who actually establish those relationships, and so they have a relationship to finance the equipment. It may or may not be done on a private label basis, but in terms of, do I see a difference in terms of fintech? What I see is that the trend is that more and more financing is being done, whether it's through the captive or the vendor or online through a captive or a vendor. More of the financing decisions are happening where the decision is coincident with the decisions about the product. And as a matter of fact, another important trend is where there are models where and another example is Spark Fund in the energy space, where financing is available at the point of sale and when those decisions are made. Their early data says that the customer stickiness is higher, the conversion and the size of the transaction is bigger.
Okay, great. Another question in here, in terms of fintech, is it an all or nothing proposition? I guess I'll open that up to the group.
Well, I feel that There are a couple of different models that have been implemented. Some large lessors carve out a portion of their business, like maybe a subsidiary or a particular portfolio, and try and implement the fintech solution on it. In some cases, the operations of these new entities are so small that they are unable to provide the financial justification for implementing the larger systems. Uh, another another approach is to take it depends on your portfolio size, but another approach is to take your current book and just entirely replace it with a fintech solution. And that's entirely possible. Patricia, John, do you want to weigh in on that?
Uh, the only thing that I would add to that is that lessors can actually consider making investments or strategic investments and when we talked about vendor programs and vendors, they can actually look at creating a fintech service model for various vendor relationships and invest in that technology without disrupting their entire enterprise and their entire IT infrastructure. So I think strategic investments in this space actually give people the opportunity to learn and may get them closer to vendors who are very interested in also participating in this technology and this origination capability.
Yeah, and the last piece I would add to that is there's a lot of different ways to do that, right? So you can look at it and say, well, do we build it, and do we use some of the technology providers out there who can offer us good solutions to help us deploy our own solution? Or do we, in some of the examples I said before, do we look at acquiring companies that have this technology, whether they're alternative lenders today, or do we partner with some of them to do some sort of strategic alliance or some sort of investment in order for the entity to be able to deploy that technology for their own customer set?
So let me follow up on that. There's another question in terms of that and implementation. What's the risk of doing nothing? What if we just what happens?
Things are moving. Things are moving. I think John is the best person to answer that one.
And even when we talked about it in leasing, we said that this is an evolutionary process, not a revolutionary process. And the fact is that there are lessors that will, and there are current lessors, and there's new entrants that come into the market using the most readily available, the best technology that emulates this particular space. And there are lessors that are going to have opportunities in the future to do it, and they may take whatever approach that they take of the ones that we've outlined and others. The fact is that when people actually and when lessors start to realize that they're losing significant market share and that their customer experience and their customers that they traditionally relied upon to do business in a traditional manner are not doing business with them, then that'll be the impetus for change. But I don't think it's going to be something that's going to flip a light switch and it's going to happen overnight. I certainly think that'll be something that'll occur over a much longer period of time for most people.
Okay. And the other thing that I'd add to that, John, is that that's the right question to ask. What is the danger of doing nothing? And I think the right place for organizations to start is from the outside in. So if you're an organization that works with vendors, talking to your vendor and seeing how they're evolving, how they're selling equipment, also understanding what is the end lessee, what kind of user experience, to go back to John's earlier comments, are they looking for, and how is that evolving, and what do they want in that financing, and how do they want to be able to access it, and how will those needs evolve over time? I think reaching out and finding out for your own stakeholders, your own constituencies, what is changing, what are they looking for, will help organizations really understand what the impact is and how quickly and what areas they should address first and how much urgency there is in the question overall for them.
So this was part of the discussion question that came in. With the increased use of technology, I imagine new lease marketplaces to compare offerings will be created, right? similar to exchange leasing for Uber. Do you see an increase in lease marketplaces? How do you expect this to play out?
Let me go ahead. Go ahead, Patricia.
So I mentioned one at the onset. So Currency Capital is although they keep a small percentage for their own book, they are essentially a marketplace. And so they have many lenders on the back end, and they're trying to match the credit criteria and credit sweet spot of those lenders and the types of duration of deals and credits and assets they like to finance. And I think that will itself create a whole lot of information that will allow them to refine that over time, both for them and for the lenders on the platform, and provide better products for the end customer. So there's others. I mentioned one, Spark Fund, in the energy space that works on energy efficiency, and LeaseQ is another one that John mentioned. So we're starting to see them, and I think that we'll see, yes, I think the trend will be to see more of those over time, and I think the trend that will lead to smarter underwriting and better matching of assets to finance sources.
One other point I'd like to add about that, Scott, the leasing industry, one of its differentiators compared to bank lending has always been the asset residual investments that they've made and the asset management capabilities that they've made. So when you talk about marketplaces, what ultimately, a thing that could happen, and nobody knows for sure what's going to happen, but when you think about it, there is the opportunity for users of equipment to be able to access multiple lenders that have an affinity to a particular asset class. And lessors that are interested in investing in those assets from a residual perspective will be in one place for people to do business with. And the differentiation of those offers, the convenience, the ability to upgrade, the terms, the original pricing, whatever the case may be, that could create a marketplace, or those options could be available to users in the marketplace. Now, how that evolves and when it evolves, nobody really sure. But when you think about it and you apply the fintech model or the multiple funder model to the leasing space, that's the difference between leasing and loans, and that's the difference between bank lending. It's really the asset management side. So the asset managers of the future and the niche marketers of the future may have a competitive advantage in that kind of environment.
And I think that brings up an excellent point, John, is that, for anyone on the phone who's in the leasing business knows well that there's quite a few differences, the asset management being an excellent example, between leasing and loans. But some of the alternative lenders in the loan space, it is different because they're not dealing with a vendor or the third party who's providing the equipment. It's not secured lending, and there's not the asset to manage. So I think it is different. I think it's more complicated, and I think that's why the introduction of an online example in this space has lagged behind some of the unsecured, straightforward loans. So there's a lot of moving pieces here.
So let me ask a follow-up. In the marketplace, who ends up owning the asset if you've got this peer-to-peer relationship?
That's the elephant in the room.
Is it?
So, that's probably one of the reasons why marketplace has not as yet developed to that extent in the leasing sector.
Yeah, so in the examples that we're seeing out there, it's really no different than if they're originated through a really traditional source, right? So there's fair market value leases that are being offered out there that offer options to customers at end of lease in terms of purchasing the product or continuing to pay. So that piece of it, in terms of who owns it and how the transactions are documented, hasn't changed so far in any dramatic way for the finance sources that are participating in the marketplace.
All right, thanks. So there's a couple technology questions, and we're going to have to wrap up here shortly. How do you feel about acceptance of electronic signatures, for example, DocuSign, in the leasing industry, and what can we do to help facilitate this so our industry is not left behind?
So I'm seeing more and more acceptance of electronic signatures. There are fewer areas which are left which require a wet signature. John and Patricia, what do you see?
I would agree. Well, I think more acceptance.
Are there any legal hurdles right now still that have to be overcome?
I have heard of certain legal hurdles internationally,
Mm-hmm.
but not in the US.
Okay. So it's really going to be a country by country basis? Yeah. Okay. All right. There was also a question of, speaking of countries, about a multi-currency and multi-country operation. So how would leasing work in terms of fintech and doing that?
So I think this is a question which we'll probably want to take offline because in you know uh, a cross-border lease is different to a multi-country operation. I think we can follow up with the gentleman who's raised it offline.
Okay. I think that's about all the time we have for questions right now. If we did not get to your questions, we will get back to you individually. We're also going to make a recording available to you once this webinar is complete, so you'll see that in your inbox. So again, I want to thank you all for attending, and I want to go ahead and thank our speakers today. It was a great informative session, and we look forward to seeing you at our next webinar. Bye for now.
Bye.